we're here to talk to you about a management company, how it works as a business, and the overall responsibilities that that type of business has here in Luxembourg. Interestingly, as we were just talking earlier, Alan is actually responsible for the Luxembourg office of the Duff Phelps group. But in addition to that, he is the global head of risk consulting for the company. And I think that combination is quite interesting because obviously it shows a little bit about how your organisation works and how key Luxembourg is for you.
Interestingly enough, the decision has been made to locate the risk management expertise in Luxembourg because this is where it is today primarily domiciled. Of course, my role is to make sure that this will be expanding throughout the globe, so to speak, and that we have the capabilities to advise and bring good services to our clients in many jurisdictions.
Could I just pick up a bit more on that? Because I think that's in the illiquid assets area.
Yeah.
So for everybody sort of watching, that is in the area which has been really impacted by the Alternative Fund Management Directive in the last few years. And I think what's interesting about the illiquid investment business, so that's real estate, private equity and other types of investment strategies where the strategies are not on the stock market.
Yeah.
You've obviously seen that this area has become very difficult to value. Obviously your clients are coming to you. Why is it that your clients are actually going externally for valuation services these days? What's the benefit?
I guess there's a combination of drivers really. One is undeniably the question of expertise. On the one hand, it is not, from a pure modeling perspective, it's not complicated to value this instrument. You can understand the models, you can understand the basic principles, you can be comfortable with the foundations, but there's a big gap between this and between being able to provide a fair value for an illiquid asset. So I guess the first point is really about expertise, and that interestingly has always been there. If you look in the US maybe 15 years ago or something, there was a big demand from LPs, limited partners who are investing in private equity, real estate, infrastructure fund. And the demand was, look, we have this valuation. Obviously, we are fairly decorrelated from markets, but what it is that this valuation is actually telling us, to which degree should we be related to markets? Is there someone out there who can look at this valuation and gives us insurance as investors that the valuation is sane, sound, and actually accurate? And that came actually without any sort of regulatory impulse, interestingly enough. It was purely investors who realized that given their investments, they should have recourse to a specific third-party value, if you want. So I guess if you look at this genesis, and you now sort of expand that to the situation that we have in Europe, it's now materializing more along the lines of the regulatory prescriptions, if you will. So that's more the IFM directive, which has sort of taken the relay out of this sort of industry need, which was expressed by limited partners. And now the directive has materialized that there is a function that the manager must have in place, which is this valuation function. And the manager, which is responsible for pretty much managing assets, the risk as a standard, I would say, operating model, becomes on top of that responsible for the valuation. And now the regulators also add another element of independence. So they say, look, the asset manager is responsible for the valuation, but obviously the valuation cannot come from the portfolio management function. So what it means, when you pile this up, needs for investors, difficult subject which needs expertise, plus independence, when you combine these three elements, these three drivers, you end up in a situation where naturally you need either to engage with, let's say, a third-party provider that can effectively do the valuation, or at the very least, equip yourself independently from portfolio management with a dedicated expertise, in-house or external, to do these evaluations.
Yeah, and I imagine that from, if I was investing in something with my own cash, I would like to know that there was somebody other than the asset manager or the investment manager providing the oversight on the risk on the portfolio than that asset manager themselves, because of course there's a conflict of interest there. I think it's quite interesting for people to understand a bit more about why Luxembourg is such a key area for your business and what it is around the regulation that drives these businesses to be domiciled here in Luxembourg over and above other centres in Europe or perhaps in the States.
I think that, of course, the answer to this requires a bit of development, but I think the best way to start is to look at what happened historically. So, historically, there's been this pioneer vision, which some people had in Luxembourg, according to which funds should become product. That was the first idea, actually. That was the idea of creating this UCITS fund. And these funds, they would actually tick the box in terms of a number of, let's say, desirable features, such as having good risk management, having a conflict of interest policy, having good compliance, having good internal audit and everything. So pretty much you can see that fund management, which was always there more or less, has sort of taken a new departure, so to speak, it's been a new hedge for investment management when the UCITS product was actually created. And regulators, they were definitely thinking along the lines of expanding the UCITS framework to something which recognizes the specificities of these funds. But I think they've been caught up by the crisis, which happened in 2008, which effectively fueled the demand for a systematic approach about how do we manage these funds and how does the industry effectively implement similar measures
on those
funds. The innovation was that the angle subtly changed, but this subtle change realizes in a complete transformation of the industry now. Because the standpoint of regulators was not anymore to regulate the fund, but to regulate the manager of the fund. So that is, as you can imagine, a substantial change, because now directly the object which is regulated, if you will, becomes the investment manager itself, not the product. So in terms of responsibility, in terms of capital allocation, in terms of expertise, in terms of substance, it is all the matter of the investment manager in reality.
Can I just pick up on that? Because I think that's a really big point. So I think that for for people perhaps watching this, the fact is that when the regulators reacted to the crisis, they obviously wanted to put in measures that would make the fund manager much more responsible for how they go about their business. And so it really isn't the case that Luxembourg is full of these sort of empty offices. If companies are working here, they have to have board decisions taken here, they have to have enough staff here, they're not just a post box. So all of the idea of Luxembourg just being a country of empty offices is really not the case anymore. I think that when companies now, smaller businesses, perhaps smaller fund managers now approach this problem, obviously we arrive at the management company answer, because if you're a small asset manager with just several billion under management, not a really global big business, then you're just not going to be able to set up your own office with 25 staff locally, because it just wouldn't be cost effective, not just for you but for your end investors. So maybe that brings us on to a bit more the topic about the management company business. Could you tell us then how they arrived really at the idea of an independent third party management company business, and what it does and how it works for the asset manager?
So, what a third-party management company does is, specifically in that case, to retain internally risk management and to sub-delegate portfolio management. So the management company will not be involved in daily portfolio management matters. It will typically retain the risk management internally arguably here on a purely independent way, because there is a clear segregation between the management company, individuals, and the portfolio management, which has by definition been delegated. So the management company will effectively review the portfolios, will do the risk management, will do the internal audit, will do the compliance, will do the supervision of all the operations. And this is a big subject, because when you have a fund in Luxembourg, you have your transfer agency, you have your NAV, your fund administration, you have your depository, you may have some prime brokers here and there. So you have a constellation of service providers who revolve around the fund. Well, these service providers, they actually all contribute to the fund value chain, but the management company is the one entity supervising all the flows, monitoring the operational risk, and making sure that this is done, I would say, in harmony, so to speak, that it works well. And this is again a very substantial role.
It's really looking at every single thing that is performed as an action in the fund, and assessing every part of that. And I mean, some of these funds that you work with are just huge. They're billions or even trillions. I mean, I think that some of the funds that run through Luxembourg are, they're the biggest investment funds in the world. And I think it's very helpful for people perhaps watching this who maybe aren't aware of the function of these kind of businesses in Luxembourg. They add a huge value in terms of managing every single different layer of the operational risk of the business. So they will look at things right down to simple IT processes. They will look right down into every single financial calculation in the fund. And because it's a third-party business, there's no incentive to report in a particular way. And a lot of the third-party businesses in Luxembourg have been growing fantastically well over the last few years, because it represents such a good solution for asset managers to get the benefit of distributing their funds all over Europe, while at the same time maintaining an extremely good local understanding of the high level of regulatory, legal requirements that are really placed on these type of investment businesses. And I think that if people really saw and understand the workings behind that, I mean, to be honest with you, it's not too indifferent to the way that we work in our own company. I mean, we're a recruitment business, but people can easily think that our job is straightforward, but until you really understand what goes into it, then you can understand the complexities and the detail that you will go into on behalf of your client. And I think it's like every good servicing relationship, that over a period of time, suddenly problems become mitigated, things become easier, and over a period of time, there are less and less issues. Of course, you still have the issues because life is not perfect. But the point is that when you actually have a good operational structure, they're really minimised. And when we're talking about big investment funds, that's people's pensions. That is all of our interests really invested. So I think the management company business area and actually looking at risk is a huge responsibility.
Yeah, it is. Yeah.
Good. Well, that's been really interesting. Thank you very much for coming by today to explain to us all a bit more about your business. I hope you guys have enjoyed watching the show, and see you next time soon.